calculate profits. Welcome everyone. In this video, I want to show you how to calculate profits, and specifically, I'm going to use a DIA calendar example. So when you're putting on positions, taking them off, you have adjustments, you have rolls, you have all these different factors playing into your position. Sometimes it's a little bit difficult to figure out exactly how you came out of the trade once you close it out. So I want to walk you through how to do that specifically on a calendar spread, and in future videos we'll look at different types of trading strategies and how to do the same thing. So let's take a look at this trade from beginning to end. So what we did was we entered a calendar spread back here on February 9th, 2017, right on this day here. I've marked it with the arrow. So we entered, price was right around a little above 200. So we entered a 200 strike calendar spread. And so if we take a look at that, if you go to your monitor tab, and for those of you who are not familiar with this feature, you can simply click on days back and you can change that to whatever you want. So I picked 27 days back because that's how many days that we were in this trade specifically. So you can see on 2/9, 5 contracts, DIA calendar, front month was March, back month was April, 200 strike, and we paid $1.41 for that calendar. Well, what happened was over the next few days, DIA just continued to shoot basically straight up, right? And it broke through our break even, which, as I teach in the course, that's our time to make our first adjustment. So we simply added another calendar, and based on where price was right there, we added the 205 calendar. So you can see on 214 we added the 205 calendar, paid $1.10 debit for that. So now we had a double calendar on. We had the 200 and the 205. And then we continue to wait, and what happened? Market just continued to move higher. So we had to make a second adjustment, and the second adjustment we made was to simply close out our original 200 calendar. So you can see the 200 strike here. We closed that out and sold it for $1.02. So we paid $1.41, sold it for $1.02. So we took essentially a short-term loss on that position. And then we added the 210 calendar. So you can kind of think of this as we're playing leapfrog here, right? We put on the 200, put on the 205. The 200 was the one hurting, so we took that off and put on the 210. And so now we had the 205 calendar on and the 210. And so we just continued to monitor that position. And then today, which is March 7th, we were able to close both of those out, both the 210 and the 205 for the credits you see here. So if we take a look at let's go back to the slide and take a look at exactly what happened here. So again, we entered initially on 2/9 with the 200 calendar, paid $1.41. Our first opening adjustment trade was on 2/14, where we simply added the 205 calendar. On 2/23, we made a closing adjustment by closing that original 200 calendar and added the 210. And then we just continued to wait, stayed patient, didn't panic, and then today closed both of those out to completely exit the trade. So as you can see here, when you break down exactly what happened, we bought the 200 calendar for $1.41 and sold it for $1.02. So gave us a negative 39 cent as far as P&L. Then we bought the 205, and then we closed that out today. We bought it for 110, closed it out for 117, so we got a 17 cent profit on that one. And then we originally bought the 210 calendar for $1.22, sold it out for $1.55, giving us a profit of 33 cents on that one. So if you total it up, we've got a profit of 33 cents, 17 cents, and then minus 39 cents. Gives us a total profit of 11 cents. Multiply that by 5 contracts, because that's how many contracts we did. So that equals 55, and then you multiply that times 100 because each contract controls 100 shares of stock. So that gave us a total profit on the trade of $55. So you might be thinking, well, big deal, $55. But keep in mind, this was a tiny trade to begin with. And the reason I like showing this is because you can do this size trade in any account, right? You don't have to have a huge account to do this trade. And when you look at this from a return on capital standpoint, the ROC, essentially we made 22% on the trade in 27 days. And to calculate the return on capital, I'll just bring out my little calculator here. You can see the total risk that we had in the trade was initially it was $1.41, 1.41, and then we added a second calendar. So you have to take that into consideration. You have to consider that real risk. So if we take $1.41 plus the $1.10, that equals $2.51. So $2.51 is the max risk that we had on this trade. Now, when we exited this trade, the 200, and we added the 210, we put this on for $1.22. So that actually reduced our overall risk, because remember, this is the one we paid $1.41 for. After we took that off, we put this back on for $1.22, but not as much as that. So the total max risk that we ever had on the trade was $2.51, right? And our total profit at the end was $55, or 0.55. So if you take 0.55 divided by 2.51, which is your total capital usage or total risk in the trade, that equals 0.219, or 22%. So we made 22% on the trade, and we're in it for 27 days. And remember, this is on a trade that went completely against us, went completely one directional. And what's the risk that we have on these income trades, on these delta neutral trades? It's large, extended, one-way moves. And that's exactly what we had here. And even though we had that, just with this tiny little pullback, a tiny little pop in implied volatility, and just being patient, staying mechanical, we were able to make a 22% return on capital in 27 days. So this is a trade that really, anytime you adjust trades or roll trades or have to make any type of adjustment, really you're kind of in defensive mode. So you're really looking to get out of the trade with a small profit or a break even or a small loss. In this case, banking a 22% profit in 27 days. I mean, think about that. If you calculate that out, and you do that every 27 days, that's a pretty good annual rate of return, right? So I just want to show you this to show you the power of staying mechanical, sticking with the trade. Don't get scared out. Don't get nervous. Don't start having an opinion on which way you think the market's going to move, because that will always come back to bite you, because you never know. Half the time you might be right, half the time you're going to be wrong. But stay mechanical, make the necessary adjustments, and over time, your profit is going to steadily increase as opposed to being a roller coaster ride. So, hope that was helpful. If you'd like to learn more about the different strategies that we use to make consistent returns, come see us at NavigationTrading.com. We've got a ton of free resources, including the Navigation Watch List, which is a list of the most profitable symbols to trade for each type of strategy. We've got the Volatility Indicator, which you've seen on my charts. You can download this directly to your Thinkorswim trading platform. And we've got a free options course called Trading Options for Income, which is a step-by-step guide to get you making consistent trades right away. We look forward to seeing you there.